All right, well, welcome out to the Blue Sky Trading Lab, ladies and gentlemen. This is Coach Matt. We're going to be talking today because it's Fed week, it's Fed day. This is the second day of Fed day. The understanding the Fed and understanding how to trade the Fed specifically is unlike any other key economic report out there. When you deal with economic reports and when you're dealing with like the economic calendar, well, let me ask you guys a question first and foremost. How many of you love trading economic reports? Like they're just your thing. You love trading economic reports. Not sure you're new. Archeolo, one micro. Anon, you hate the chaos. Boba's like, nope. Ranger's like, so. How many of you were watching Mike yesterday navigate the central bank? Who here was with Mike yesterday when he was live trading the central bank? Man, watching Mike do something is quite astonishingly amazing. Like truly, he's such an amazing trader. And when you're watching a professional trader navigate that type of volatility, it's really impressive, number one. But number two, when you're thinking about doing it for yourself, what type of emotions did you guys feel yesterday as you were trying to navigate the Fed? Was it quick, volatile? Were you excited? Were you a little bit nervous? Like how were your emotions yesterday as you were navigating the Fed? Are you warm, tingly feelings? Nacho, you a little bit nervous? Yeah, totally understand. Waiting on Thunder. So Thunder, you're like, oh yeah, I'm excited, but ended up going against you. Yeah. I wanted to talk about the Fed here today and navigating the price action because when you're watching a professional like Mike, who has traded the central bank more times than he can count, understands volatility like the back of his hand, knows how the initial price movements are going to go, and quite frankly, with that type of speed, do you even have time to think before you take action? What's up, Blas? Do you have time to really sit down and prep your trade and make sure you have an edge and make sure you have a positive reward to risk ratio? Do you have time to do all of your standardized things? No, you have to trade, right? It's second nature. You have to trade. You see it, you pull the trigger. A professional can do that because it's in the back of it's like they've done it a billion different times, right? It's like riding a bike. You just go out there, you start riding your bike. But for people that have not navigated that, and that's what this lab is really about, is to teach people to the point where they increase their financial IQ. And would you guys agree with that? That every single week, it's our job to increase our financial IQ every single week. We come to this lab so that we can get better as traders every single week, correct? That's kind of the goal. Well, that's kind of my goal here today is to understand the central bank. Because if you had some uneasiness yesterday, if you had any degree of emotion yesterday, you probably shouldn't be live trading the central bank announcements. Can we all agree with that? That if you have any degree of emotion, if you have any degree of uneasiness, if you don't feel like you have the confidence, then you probably need to wait on the central bank. See, the thing about the central bank report, ladies and gentlemen, the FOMC, when the FOMC reports monetary policy, it is unlike anything else you ever deal with from an economic reporting perspective. Economic reports come out every single day throughout every single currency. We get major reports, minor reports. Some have massive price movement to them, others don't. For example, a couple weeks ago, we sat down in this lab and we really tried to understand the labor market data going into the labor market print. And if you'll remember the conversation when we back tested the labor market, it took about 30 minutes for the volatility to subside. on retail sales report, for example, it will take maybe 15 minutes for the volatility to subside. When you're dealing with the Philadelphia Manufacturing Index today, it took 5 seconds for the volatility to subside because every economic report is a little bit different in how the algorithms will treat it. And where it becomes really important in economic reports, guys, is everything leads to how the central bank is going to act, right? Exactly, Anon. That's kind of my general point here is that every single economic report will go on the volatility of how the traders and the investors think that's going to influence the central bank. Every single thing leads to what the central bank is going to do. So when we get labor market numbers, we see more volatility in labor market numbers because labor market numbers are the number one impact to what the Fed is going to do from a monetary policy perspective. When you look at inflationary numbers, they have a tendency to be very sensitive as well because that's number two in the importance ladder in terms of how the central bank is going to navigate monetary policy. And so you deal with the Philadelphia Fed Manufacturing Index. Is the Philadelphia Fed Manufacturing Index, is it going to play any role in how the central bank sees monetary policy moving forward? The answer is no. That's the answer. And so is the Philadelphia Fed Manufacturing Index is kind of one of those analogies that goes, if a tree falls in the forest, does it really exist? That's kind of the Philadelphia Fed Manufacturing Index. So when you're dealing with the central bank is the epicenter of all economic reports. It is an all eyes moment. And when it's an all eyes moment, you're going to have more volatility. Now, Thunder, you ask, how do you analyze news before it comes out? No, well, there's a couple different things that I do in terms of understanding what I feel the price is going to behave under. Number one, I think the most important thing to do is just to understand when data is in fact coming out to the market. A lot of traders get hit by volatility when they do not understand the calendar itself. They're in a trade and they're like, oh my goodness, the volatility just hit the marketplace. What am I going to do? And it's like, well, you just traded in front of the retail sales report on Tuesday or the Fed on Wednesday or initial claims on Thursday. So I think the number one thing is to have an understanding that when these economic reports come out. Forex Factory is a wonderful economic calendar to be able to do that. That's number one. Number two, as a day trader, it's not really about building your expectation before the event as a day trader. It's about understanding your levels going into the report. And so it's about identifying your levels technically going into the report and then being able, like Mike did yesterday in the live stream when he was live trading the Fed announcement, being able to quickly make decisions at those key levels as you are navigating that volatility. But from a pure economic reporting perspective, let me ask you guys a question. As a day trader only, do you care what's actually reported as a day trader? Like, do you care that retail sales comes in a beat or retail sales comes in as a miss? Do you care as the trader itself what the Fed does with monetary policy or what they said about the dot plot or what they said about the SCP? Or do we really care about Jay Powell's opinion on what he's going to do with inflation when he gets fired next year and he's not at the job? None of that do we care about, guys. And so in terms of the preparation, it's really about one to two things. Number one, understanding when the report is coming out. Number two, understanding how historically the market behaves around this specific report. And number three, understanding the levels going into the report. And then number four, it's all about trading that reaction. It's all about understanding your ability to navigate that price action after the event. That's where the skill as a day trader comes in. And so as a day trader, I really don't care about what the number is. Now, I will tell you this. Longer term traders, swing traders, position traders specifically, I'm not talking about the investors. I'm talking about the longer term traders and the day traders, the swing traders and the position traders. They will do further preparation in terms of these reports because you can get a pretty good understanding of how the market's going to behave depending on if the market is overextended at resistance or is setting at a support level. Is this a high bar expectation from an overall expectation perspective? The conversation is much, much, much deeper on economic reports when you're dealing with trades that are more than that, are more than just what you're trying to understand from a price action perspective. But in day trading, it's really about just understanding the levels coming in, when these are being reported, and then navigating as that price action does take into hold. Now, when you deal with like an economic report, like initial claims, unemployment claims comes out every single week. It's not going to be a major thing, and you're not going to see volatility continue long term, meaning 30 minutes, 45 minutes, an hour. Price comes, price moves on, right? Minor economic reports, very, very similar. The major economic reports, like what I would consider labor market data as well as CPI data, the number one inflationary report, that will take about 30 minutes for volatility to kind of settle in. The Fed is not an economic report, not to the same degree that labor market data comes in. When the labor market data came into the market, you get the number, the market moves, and then it's a technical conversation. It takes about 30 minutes before it becomes a pure technical conversation. Same thing with inflationary reports the next week. And so the week after, on the first Friday of the month, we get labor. The second week, we usually get CPI and the PPI report. Once that comes out, it takes about 30 minutes to price in. Market settles in, market moves on. When you're dealing with the central bank, this is an event, and you have to understand how the event works to truly be able to navigate it, in my opinion. There's three stages to the event of the central bank. The first is what I would consider, and everybody write this down. The first is when the policy statement is released. That is at 2 p.m. every time the Fed meets. The policy statement is released at first. Now, when you get the policy statement, let's go in and let's look at the price action here. When you get the policy statement, you're going to have an initial move, and the initial move is extremely sensitive to price. It's extremely volatile. It's extremely sensitive to price. And a lot of times, the initial move is not the real move. This is simply based on the headline that comes out. Fed is expecting rate cuts. They got rate cuts. Algorithms are the only ones that were doing this. And that initial move was up for about 5-6 minutes before we had it snap back all the way down to the downside. The initial move on Fed Day, and really kind of this zone, if you're thinking about it from a time period perspective, is the first 30 minutes of the Fed Day. And so from that move till right here, all of this right here is all the policy statement volatility. When the policy statement comes out itself, that's all we know. The only thing we know is what they did and then what they changed in the policy statement. Those things are important, but that's all that comes out in the first 30 minutes. You really don't ever have a market pick a direction during the policy statement, guys. I've traded probably more Fed days than everybody here combined. Okay. And I've certainly studied the Fed probably more than less than a fraction of people in the entire world. And I'm going to tell you right now, in the first 30 minutes of the Fed, you do not get a true reaction yet because it's only algo on algo type stuff. It's a big time algorithm battle. You don't get a lot of probability edges during the policy statement as initially, and extremely rare to get a trending environment. during the policy statement, because it's initial algorithms. And when you're dealing with the Fed, the 0.25 cut had nothing to do with anything that transpired over the last 24 hours, guys. The 0.25 cut was priced into the market weeks ago. Weeks ago. Not one person in the world was surprised yesterday when the Fed released the policy statement and it said, we're cutting 0.25 interest rate. Not one person in the world had the ability to read the SCP, had the ability to navigate the dot plot and have an understanding of exactly what the Fed is doing in the first initial move. That is not happening. It is all algorithms all the time. Now, doesn't mean you can't catch an edge. It doesn't mean you can't trade in that first 30 minutes. It just means that you do not have a trending environment. And anything you're doing there, in my estimation, is extremely aggressive. And again, aggressive doesn't mean bad, guys. It just means that you go into that trading environment knowing you're going to be dealing with a lot of whipsaw. You're knowing you're dealing with a little bit of volatility, and you don't necessarily have a big edge here, right? You don't necessarily have a big edge here. Now, so once again, who dominates? What type of market participant dominates in the first 30 minutes of Fed Day? Who is it? Is it the hedge funds, Wall Street institutions, retail traders, the bankers? Who is it? What participants dominate here? They dominate everything. RQ, I'll do you one better. They're not dominating during the actual trading session. They got the information before the event even came out, which means they've already bought their stuff, right? They've already bought their 6 month call options and yeah. And Primo and MJ, what do institutions use? Do they use human beings to make decisions, or do they use algorithms to make decisions? They use algos, right? Okay, so everybody put algos. Algos dominate the first 30 minutes. They dominate the first 30 minutes. Now, the second 30 minutes to an hour is all about the press conference. And the press conference is crazy, ladies and gentlemen, because the press conference, the market will move based on how Powell answers questions. And so you're going to get a lot of whipsaw. And if you're going to be trading in that environment, you're going to be on a very short time frame and you're very quick. You're very quick. And so when I'm looking at the first 30 minutes here, okay, and I'll just kind of explain it how I navigated it yesterday. When I looked at the first 30 minutes here, did I do anything in the first 30 minutes? From a day trading perspective. I'm not talking anything else. I'm just talking from a day trading perspective. Did I do anything in the first 30 minutes yesterday? I did not. I did not. Because when you deal with Fed Day and you know it's algorithms and you know price is going to be extremely sensitive, I have a philosophy when I know volatility is going to come into the market. Okay. And can we all agree that we know volatility is going to come into the market as the Fed releases monetary policy statement? Can we all agree with that? And can we all equally agree that in the times when the Fed also introduces the SEP and the dot plot, that you're going to see some additional volatility? Can that be the base case for all of us, that we expect volatility here? When you expect volatility, guys, volatility is just speed of movement. That's all it is. That's all it is. It's not up and down. It's just speed of movement. And when I look at the algorithms after the Fed announces policy, I don't really see a lot of consistency in price action. And that's what I love more than anything. I love consistency in price action. I love consistency in levels. I love consistency in pattern development. I don't love volatility. I love the volatility and when it works for me. I don't love the volatility when it works against me. I love consistency as a technician. If that consistency is volatile, fantastic. The fantastic. But I do love the consistency of price action. And so when I kind of have a philosophy that when I expect volatility, volatility is like a dam breaking in the market. And as the dam breaks, all the water floods and you have flooding everywhere, volatility's everywhere. And like a dam breaking in real life, it's very scary, it's very sensitive, it's very volatile, but you don't know the damage until the volatility subsides. You don't know where the actual levels in the market that are important for you as a trader until that volatility subsides. Because let me ask you a question, everybody. What is the kryptonite of all things price action? What is the kryptonite of technical analysis? What cares nothing about your levels? What cares nothing about technical analysis? News. When news comes out in the market and the market's pricing in that news, it does not care about your levels. It doesn't. Does everybody understand that? That you do not have a technical edge when news is coming out in the market? There's no technical edge when the kryptonite of pure technicians is volatility. That is it, the true statement to technicians because we love our levels, correct? How many of you love your levels? I do too. How many of you love pattern development? You love a good pattern in the market. Okay, I do too. Who loves a consistent trend in the market? Yes, yes, yes. Do you have any of that when the market is simply trying to price in the news that is coming into the market? It takes a little bit of time. Okay. It takes a little bit of time. And like I said, on like a normal economic report, it might be 5, 10 minutes. It's nothing. It's nothing. On the Fed, it's a little bit more, guys. And so in the first 30 minutes, I really don't ever try to have a strong opinion of what price is going to do in the first 30 minutes. What it can do is help us start to understand where the key levels are starting to get built, where these levels that we might be looking at in 10 minutes from now, in 20 minutes from now, later on that night. And so it's not that it's not giving us important, very vital data. It certainly is. It's helping us understand the levels post the central bank. But what it's not doing is giving you any degree of consistency. And then you get into the press conference where you have Powell answering questions, and I'll come out to a little bit of a longer term time frame here. But when you have Powell answering questions, and when Powell started answering questions, initially, what was the reaction? It was very negative. And the reason it was very negative is because Powell had some things to say that were negative. He talked at like, whereas when the policy statement itself came out, everybody's just talking about rate cuts. Oh, we finally got a rate cut. Ooh, we finally got a rate cut. When Powell's going through the press conference, he's getting asked questions on inflation. He's getting asked questions on labor. He's getting asked questions on stagflation. He's getting asked questions on the differences on the dot plot. And as he's explaining all of that, the market's getting more information and starting to understand the context because context is for kings. The market's getting the context for what the policy statement said, and now they're starting to understand where their edge is. And when you started seeing that yesterday, like I said, in the first 30 minutes, you're starting to understand where some really important levels are. And this is how I navigate it, guys. Other people might have a little bit of a different way of navigating it, but that's how I do it. In the first 30 minutes, I'm looking at where these important levels are going to be that are going to be, in my opinion, impactful a little bit later on in the day because I do love trading Fed day. I just don't love trading during the actual announcement itself. While everybody else is getting very excited about the announcement, I'm kind of sitting back preparing. I'm kind of sitting back, allowing all the algorithms and the scalpers to do what they do. I'm not criticizing in any capacity, guys. For me to be successful as a little bit more of a what I would say is a standardized day trader, those scalpers got to be successful. Those algorithms got to be successful. I'm not criticizing in any capacity. As a swing trader, I want the day traders to be very successful because if the day traders are very successful, it's going to do nothing but help my swing trade. If I'm a position trader, I want those swing traders to be very successful. That's going to help my trade as a position trade. So in the first 30 minutes, I'm looking at the levels. During the press conference, I'm looking at the volatility. And what I mean by that is I'm waiting on that volatility to decline. You initially will see a big volatility surge when Powell starts talking. But as Powell starts getting to the conclusion of the press conference, you start to see volatility decline. And as you can see volatility decline, you start to see the patterns that develop. So in the volatility surge, you're looking for levels. After the volatility declines, you already know your levels. Now you're looking for development, in my estimation. And a lot of this is simply preparing for what transpires next. See, in my estimation, it doesn't mean there's not great trades in the release of the policy statement and secondarily during the press conference. But there's two equations for me that is very important for me to answer in the real time before I process a trade. Number one, no, the bots do not listen to Powell. And quite frankly, I stopped listening to Powell about halfway through that press conference yesterday, Link. And I'm a Fed hawk. And I stopped listening to Powell about halfway through that press conference because he wasn't saying anything that I didn't already understand. He might as well have stood at the top of the stood at the top of the podium at the very first of the press conference, and every single question that he was asked, he should have just said stagflation because that's what every single word he said yesterday kind of went to is stagflation analysis. We expect a bump up in inflation. We expect we expect the labor market to contract. He sounded very worried about the labor market and was stuck between a rock and a hard place on the inflationary side of the equation. He might as well have just said stagflation, 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 stagflation. And so once that was kind of the cue, I was just like, all right, we're not learning anything from here. And I really just kind of focused on the price action after that. But the point is, as that's set forth, there's nothing new he's bringing to the table. At some point during that press conference, you're not pricing in new things he's saying. You're not even caring what he's saying. And as you can see in price, look at the shaky volatility a little bit, wicks, wicks, wicks. Well, what starts happening right here as we start getting into the close, guys? Do you see how the candles here are vastly different than the candles over here? What's not happening? News isn't coming into the market anymore. Now it's just a matter of what do you feel what was the entire environment? There's not any other battles going on here. Do you see how the volatility really subsides here? And then going into the reopen, look what happens here. Up, 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 up. My first trade yesterday after Fed. In fact, if it, well, it's not how they get liquidated, Tib. That's not it. It's that there's not new information coming into the market. Nothing ever gets fully liquidated in the marketplace unless you're talking about zero DTE. But that's just how you see it. That's not how investors see it. That's not how position traders see it. That's not how swing traders see it. That's not how even longer term day traders see it. That's just how aggressive scalpers and zero DTE option traders see it. But in terms of the longer duration traders, that's not how they see it personally. And I can just say that from my own perspective, but that's certainly not how I personally saw it. So it's more about and I know, I know, brother, I'm not going after you in any capacity. I'm just kind of explaining from my perspective When you only see your time frame, you have a unique perspective on that time frame. But when you have other things going, for example, yesterday, did you guys have did you guys just have day trades going yesterday, or did you have swing trades, investments, position trades? Like what did you guys have working yesterday? Were you sitting back waiting? Did you have other trades going? Like, so tipped, and that's kind of my point is, so you saw it through the intraday, but you also had long-term analysis, right, tipped? And Nacho, you saw it through the scalping analysis, right? Okay. To me, I don't see Fed day like that. Like I see Fed day as I don't see it as through the day trader lens or the swing trader lens or the investor lens. I try to see it through all because I got action in all. And so when you're talking about it specifically from the day trader's perspective and you just see it through that lens, yes, one aspect of that dries up, but others don't. That's my general point. It's different analysis when you're talking about it on a 5 minute chart versus when you're talking about it on the daily chart or whatever the case might be. But here's the question I have for you guys. When did I take my first trade yesterday? Was it during the Fed or was it in the overnight session? It was the overnight. It was the overnight. Because to me, it doesn't matter if it's 5 minutes after the Fed or if it's an hour and a half after the Fed. For me, it's a matter of when does volatility subside, and I feel like I have an edge. Because to make a trade, whether it's a day trade or a swing trade or a position trade, to make a trade, you need two things. What are the two basic things you absolutely have to have? Oh, tipped Intel. If you were in Intel, you love that gap, brother. Oh, if you were in Intel, wait, well done. Well done. You love that gap. That's what happens when Nvidia buys $5 billion worth of Intel. Like, wow, wow, wow. That was impressive, truly. Um, and Intel had such a good reversal. I wish I would have done that too, Tip. Next time you do that, Tim, why don't you send old Coach Matt a little message there, Tipped, so I can do it with you, brother. But that was a power move here today with Nvidia getting it. Okay, to me, it's a matter because I've said this many, many times, guys. I am a pattern trader at my levels. What does that mean? I need a pattern to be able to determine probability because the first thing you absolutely need to have before you make a trade, whether it's a day trade, swing trade, or a position trade, this is the very first thing you need. What do you think it is? It's an edge. You have to have a probability. Okay. If you do not have probability, and probability is determined technically through how you see it, but if you do not have a probability, you can't make a trade. If I don't feel I have an edge, I cannot make a trade. Does that make sense, everybody? That has to be the first thing that you have to have before you ever make a trade. You have to have that probable edge. Well, to me, and to every other technician that has ever been, what determines probability as a technician? You guys tell me. Everybody take a guess. What determines probability as a trader? Take a second, think about this, guys. I'll ask again. What determines probability as a trader? Backtesting certainly does help. Absolutely. Probability is determined through patterns. Everybody write that down. Patterns. Patterns determine probability. So when you're talking about your level and it breaks your level or it holds your level, it's just a pattern, guys. You might be talking about it in terms of, oh, ooh, it broke that level. Let's go. Well, that's a breakout. A breakout is a pattern. It has a probable edge to it. Whereas a retracement versus a high base versus an ascending triangle versus a descending triangle versus a M formation, W formation, high base, low base, you name it. Patterns determine probability. And so if you don't have a clean level and you don't have a pattern, do you have probability? No. You have to have patterns and levels, right? Levels at a minimum, patterns at a secondary. So for me, in the first initial surge, we get our levels. As the volatility declines, we see patterns emerge. And then once I feel like that has happened, I feel like you have a probable edge. And I felt going into the overnight session, there were two levels that I was very interested in. The first level I missed, honestly, I did miss, but it's this level right here at the 70 level. I went into the overnight session. I actually talked about this yesterday in the cash in Power Hour. If you guys were there, I said, okay, keep an eye on the 75 level, guys. That level is the level I'm anchoring against. I literally said it as we were going into the end of the close yesterday during Fed Day. And so it did change a little bit after the market closed, where you got some pretty decent data right here around the 70 level. And I wouldn't have taken that trade in front of the reopen, but it was a pretty good little trade right here as the Australian market started kicking. The first trade I did end up making was when it breached the 75 level here. And so it took, for me, it took a good hour and a half, 2 hours before I felt there was a real good edge in the marketplace. And whereas I didn't do a lot in the up and down nature of the market, the up and down nature of the market set forth the parameters for what I would describe a very good trading environment yesterday. So my question for you guys, and again, this is a personal choice. I'm not judging because I have my way, you guys have your ways. Traders are precious little snowflakes. I'm just trying to give you a little bit of a different context, a little bit of a different perspective, because I believe that 90 to 95% of traders should not be trading during the actual volatility of the event. I believe that, guys. And the reason I believe that is I've seen too many traders try to do too many things in times of volatility, and it really kind of beats them up over time. One time anything can work, guys. But can you trade that type of volatility over and over and over and over and over again and be successful? That's the ultimate question, because do you guys want to be trading in 20 years from now? That is a question that is self-determined. Do you want to be a trader for the next 1 year or the next 20 years? It's up to you. That was a question, team. 1 year or 20 years? What do you want to do? Because if you want to be trading for the rest of your life, you got to take out the degenerate gambler and kick it to the curb and never allow it in your life again as a trader. If you trade for excitement, you're doing it wrong, guys. If you get your heart pumping really excitable, you're doing it wrong. Vegas is there for you guys to have some fun doing that. You want to get your blood working, go to Vegas, put some money down on craps and have some fun. Trading is about be is should not be a sport. Trading should be as boring as as it can. Can we all agree with that? The more bored you are as a trader, typically the better you are. Can we agree with that? Okay, so here's my question. A, would you rather, and again, take the event out of it, just look at the volatility. A, would you rather trade the initial volatility, or would you rather trade after the volatility subsides? And again, some traders like scalpers love inside volatility, guys. I'm not judging that. For me, I love trading after volatility subsides. That's for me. And it's because I've tried the other one. I didn't like it. I didn't like how I personally behaved in times of volatility. So I like to wait a little bit. I like to wait on that edge a little bit. Does that make sense, guys? And does this review of yesterday's price action, does it help you prepare for next month's economic reports, next week's economic reports? Because we're going to be trading these a lot, right? Okay. Does anybody have any questions on processing Fed day in general? I do it on a lot of things when volatility RQ comes into the marketplace. As a day trader, I feel like patience is a position, and I'm very patient. I don't take as many trades as other day traders do. Um, I like my edge, and that has to get dialed in. But I've traded enough economic reports in my life to realize that the initial surge of this central bank report specifically is usually not the correct response. Because there's a lot of context that goes into the central bank. Obviously, the labor market data and the CPI data and lesser economic reports don't take nearly as much time. Like I said, when you're dealing with initial claims, for example, it could be 5, 10 minutes, like, and you're good. When you're dealing with, when we back tested labor market numbers a couple weeks ago, it was like 30 minutes, but sometimes it was 20 minutes before it got smoothed out and, a good little ride. And a lot of those economic reports that come out, like labor market numbers and CPI numbers, retail sales, so on and so forth, there's not the context, there's not the conversation over those numbers that you have over the central bank. So a lot of the initial reactions on those reports are a little bit, they stick a little bit more than the central bank one does. I find the central bank to be the only event that you have to learn how to navigate. Every other economic report, even the two sensitive ones of CPI and labor market data, like 20 to 30 minutes usually, and like then they're done. Like, for example, 30 years ago, that labor market data would still be being priced into the market from 3 weeks ago. Today, like, it gets priced in on a gap. It got priced in on a gap down in the market, and then everybody moved on. And so it's just one of those things that with the central bank specifically, it does take a little bit of time. Now, any other questions on the central bank in general yesterday, what they covered, what they did? It does look like we're going to get two more cuts, by the way, between now and the end of the year. So it does look like the central bank is going to be cutting in October, and it does look like they're going to be cutting in December as well as they look to reduce the restrictive territory of the interest rate itself. I want to do one last thing here today before we open up to any questions. And guys, every single Thursday, obviously, we work in this lab on technical analysis, day trading techniques, and so on and so forth. Next week we'll do a little bit of a live trading session. We'll take it kind of a think back, do some back testing. But if you ever have a question on anything technical analysis wise, guys, indicators, targeting techniques, stop loss techniques, you name it, bring it to the lab. Let's dial these things in. I love questions more than anything, guys. Love questions more than anything. The last thing I want to do here today is I want to talk about the overnight session here as we go into the overnight session tonight. The overnight session on both Wednesday night and Thursday night can be pretty decent trading environments. We saw a lot of volatility yesterday during the session. We saw quite a bit of volatility here during the session. Can the overnight action break through the noise here? First and foremost, I think you kind of got a little bit of a symmetrical triangle pattern going into the overnight session. And so I'm kind of anchoring against my trend lines here on the ES. The one that stands out to me going into the overnight session, though, is gold. I kind of like the overall development happening on gold right now. And the reason I like the overall development here, and again, I'm just talking as a day trader here, not anything longer term on gold. I obviously everybody here knows how much I anchor against gold analysis, but I love the overall development right here against support levels. The market on gold yesterday was even more sensitive than what we saw on the ES and the NQ itself. But now you're coming down to this level right here around the 68 level, and you got that double bottom right here around the 68 level. And then you're kind of kissing up against this level right here at the 680 level on gold. And so I really like the zone that you're currently developing at right around the 30, and developing means the patterns going into a breakout. And so you got some real good development going into the potential breakout. It into the potential breakout, and we'll have to wait and see if that actually takes hold. But I like that development going into the breakout. Keep an eye on the Asian session later on tonight, guys. That's one of those levels that I am looking at. I don't love the ES going into the reopen. I might have a difference of opinion as we break through symmetrical triangles. I'm not the biggest fan of symmetrical triangles. I like to see them get broke first and then trade the secondary pattern after they get broke. And so I'm looking for a violation of this triangle first on the ES. That's what I am looking at. And then gold will be the other thing I look at going into the overnight session here tonight. And that level at the 680 level looks like a real good level to anchor against. A breakout of 680 does look pretty decent. We'll see if we can get that happening later on today as well. Um, I see on GC, the first level I'm looking at is the 680 level, Blas. That's kind of the breakout level. And so when I'm going into a breakout, let's talk about this for a second, Blas, because I didn't finish the point on the two things you need to see, right? We can do that on gold here. The first thing you have to see is a probable edge. For me, I don't see a probable edge underneath 680. Okay. I don't see that as a likely scenario of success. 680 is acting as resistance. 677, I don't have an opinion on. You got to break 680. You got to get to 681, for example, for me to get into the trade. That's where I'm looking at my entry here. Now, stop loss placement. Let's all prep this trade together. Let's have Coach Matt prep this trade together. You guys want to do that? You want to help Coach Matt prep the trade here on gold? Who here is going to help me? Awesome. Now, if I'm going to enter in above the breakout channel, the question is, what number am I going to get in at? You got a wick right here around this around the 50, so I think 81 is perfectly fine. Entry is going to be 81. Now, the second question you have to answer here is first is, do you have an edge? I feel like you have an edge above the 80 breakout channel. The second thing you have to determine is your reward to risk ratio. Return versus risk is often done just in your head because you just go from entry to stop loss and you do it a little bit visual. But the first thing you really kind of calculate in the process is where would you put your stop loss here? And let me ask you guys a question. If you were going to enter in on the reopen, and we might see a little bit of volatility on the reopen here, guys, but let's say you get in at 81 on the breakout of 80 and you get in at 81. Where would you put a stop loss as a day trader? I want you guys to give that some thought. Where would you specifically put a stop loss if you were day trading on the overnight session tonight, gold? You get in at 81. Well, if you got that blown account there, Blas, you're not getting in at 81. Okay, so Nacho says below 70. Everybody guess, or not guess, but just tell me where you would put one. Ain't on 73, 69 RQ. To me, it's got to. Can we all agree that it has to be under some degree of support level. Like that's what we want support to work for us. Can we all agree with that? Okay. So let's go with that most aggressive that Tip said. Tip said underneath 2 to 3 points underneath the breakout level. Can the breakout level, if we break out, okay, if we break out, can the 680 level now be considered a support level technically? Can this old resistance level now be considered a support level? Yes, of course it can. It's one of the principles of polarity. It's absolutely. If you're a very aggressive trader, you look at that breakout channel, and I agree with tips. You looked at that breakout channel and you say, okay, as long as you stay above the breakout channel, I want to be involved. If you come underneath the breakout channel, the entire purpose of me getting into the trade was a breakout. Now you're not breaking out. Well, I don't love you anymore. That's perfectly fine. Got no problem with that. I saw, who was it? Anon, you said 73. Now, I'm assuming you said 73 because this little double wick bottom here at the support level. I think that is a really, really, really good support level right there. Absolutely. I have no problem putting a stop loss underneath that level. Now, underneath 70 here, you're going to have to be projecting this to get to 3,700 for you to actually make a trade. The more risk you take, you better be projecting higher return. Okay. Because again, remember, you have to have a 2 to 1 reward to risk ratio. So, all things being relatively equal, yeah, I would rather have the stop loss underneath 70, but I don't think I can make reward to risk ratio work as good, okay, underneath 70 as say the 73 pivot. I look at two things here, how I personally, and all three of those are perfectly viable candidates, guys. Well done, by the way, on that. Those are the three that I would have identified as well. The breakout channel one, that's the most aggressive stop loss placement, is right underneath the breakout channel. Number two would be this pivot point right here. Whatever the pivot point, the support pivot point going into that breakout, that's always going to be a proper stop loss placement. It's kind of the Goldilocks. If this is too hot, meaning you're too tight, and if 70 is too cold, well, 73 is kind of the Goldilocks one where it's just right, right? You're not too tight. You're giving it a little bit of volatility. You're giving it a little bit of range. Underneath 70 is going to be a little bit more difficult to make the reward to risk ratio. At 73, it makes it a little bit easier. And so it does in the 70 to 80 range. It does. You're absolutely right. But I would equally argue if you put a stop loss at 77, you're back into the range as well. So whether you get stopped out at 73 or whether you get stopped out at 77, the range is between really kind of 68 here and that 80. And so either way, anywhere you get stopped out under 80 on a breakout, you are right back into the range because the reason you're making the trade. Always think back to the reason you're making the trade. You're making the trade because you think 80 is going to be the new support level and it's not coming under 80, right? And so for me, the best two stop loss placements here would be the aggressive one right underneath 80 or the second one underneath this pivot point at 73. That's where I would personally put it is initially at 73, but I would be very quick to adjust right under where Tip said. And so initially, yeah, I would put it at 73 initially. But if I had two candles up, like that thing is getting smacked right underneath the breakout channel. And if I see a little bit of a development and a pivot, I'll adjust it to break even really, really, really quickly. So I would personally put the initial stop loss underneath 73 with the anticipation to move it up. I just don't want to be kicked out underneath 80 just because the tick comes underneath 80, goes right back up because we do deal with a little bit of cash opens. You want to give it a little bit of room. And again, I'm not trying to argue against that underneath the breakout channel tip because I do it all the time. Like legitimately, that's one of my favorite stop loss placements is right underneath the breakout channel. It's a very low risk, high return environment. You get stopped out a little bit prematurely, but you more than make up for it over time with the high return versus the risk ratio. And so to me, underneath the breakout channel one, underneath the pivot point two. I do think if you get it underneath 70, that's more of a position trade you're willing to carry. Not a position trade. That's more of a 10 points on gold is a little bit more than 10 points on the NQ. Let's just put it like that. I think it's a little bit bigger than I personally would like here. But again, I could be convinced if you're looking a little bit longer term there. Did that help that stop loss discussion, guys? Okay. Now, the last thing you have to have, obviously, before you make that trade is where do you think it's going to go? Where would your primary target here be? Everybody tell me where your target here would be. Everybody give me a number. Target's a little subjective here. I think 37. I think this level right here, 37, it's a significant whole number. Gold loves its significant whole numbers. I think anywhere around the 37 area. If you're slightly under it because of the wicks here, I think you're perfectly fine between 98 and 99. It's just got a lot of pivot points at 37. So, and again, if you're right underneath that, like that's not a bad thing. Okay, but I think 37 is pretty the easy number. And so, would that be a good trade? 20-point target, 7-point stop loss. Is that a good trade? Yeah. In gold? Yeah. It's a good trade. It's a good trade. All righty then. Did you guys have fun today? Did you guys learn something today? That's the goal every Thursday, ladies and gentlemen, to always increase our financial IQ and have some fun doing it. No doubt about that. Um, I I do have a question for you guys, and this would help me prepare for future labs as well. And you can send me DMs on this question as well. You don't have to answer it right now. Just something to think about. What are some topics that you guys would want to focus on in learning in this lab over the next month, for example? And again, you don't have to answer now. If you want to give it some thought, send me a private message. That's perfectly fine as well. But what are some things you want to work on over the next month? And what I will do is I will prepare some lessons to help us understand that. Um, Discussing it, I haven't sat down and detailed the differences between scalping and what I consider day traders. But we can certainly have that conversation, Anon. It's just a time frame difference. How to overcome entry delay. Gotcha. All right, and again, you do not have to answer today because I'll be preparing lessons over. Most likely, I'll be preparing. It depends on the topic. Sometimes, if we're doing a very detailed topic, it takes me a little bit of time to prepare the lesson. Other times, when we're just doing like technical conversations, it's pretty quickly. But if you do want to work on some technical concept, some trading concept, some, psychological concept, let me know. I'll prepare a lesson. Outside of that, guys, I had a tremendous amount of fun here today. Appreciate you guys hanging out with me in the BluSky Trading Lab. And as always, thank you for being the best part of BluSky. Truly enjoy teaching this lab every single Thursday. Love hanging out with the team every single day, every single Thursday. My question for you guys, just tell somebody about it. Not even a question, more of an ask. Just tell somebody about it. Tell somebody about BluSky. Tell somebody about what we're trying to build over here in the BluSky lab and the BluSky streams and the power hour and everything we do. Love BluSky. Spread the good word. RQ, I will see if I can. Let me check my love you too, blogs. I'll see if I can check my schedule there, bro. Yeah, I'll see. I'll see what I can do. I'll see what I can do. All right, team. I will have you only one request. There's got to be at least three here, brother. At least three. I'll have the lab up and running on YouTube tomorrow. Would appreciate any like and comment on the lab. I'll put the link into the futures chat when I do get it up here tomorrow. Outside of that, I hope you guys have a blessed and wonderful, wonderful rest of your day. And if you need anything from me or anybody at BluSky, hit us up. Later, team.